So we've got a client, I'll give you an example. I'm obviously not going to say who the client is, but we've got a client right at the moment who's got a trust, and they've got 4 investment properties in this trust. And they got some advice, and they were pretty smart, and they got into trust fairly early, and had a few properties outside of trust and bought 4 in the trust and kept buying because they didn't realise how borrowing capacity would affect them. And they bought another one in the trust without speaking to me before they did it. And they didn't realise then, because they put that extra one in the trust, now their serviceability wasn't there. Because if you're buying in that trust, that's a business. So that business has to show, if you're buying in the trust, that business has to show the serviceability. And they didn't have to do that. So we had to change the structure of that last property, had to change the contract of sale, to make sure it's going to meet the guidelines to get what they needed. So we caught that early, luckily.
Very lucky.
But what I'd say is the number is determined on a couple of factors. One is the serviceability. That is, if you kept buying the same trust, that trust has to have the serviceability. So we need to look at that. And also, income. Sorry. And then also, the business nature. So like you said, is it profitable? So it depends on the style of property you're putting in that trust. So we have some people who mix commercial and residential in a trust, and that's okay, because generally commercial sometimes might have stronger cash flow than maybe a residential. And so people might mix it up. They might have an office in there with a couple of resis, whatever it is. That's fine. So it's not really for me the number. It's more so the style of property and the income of that trust, which determines how many can sit there. And look, you can look at liability, because commercial might have a different liability profile than a residential as well. So you need to take that into account. Especially we've got clients who buy a lot of shopping strips, and that has a different liability profile than someone buying just a standard resi house. So you're doing like medical centres and things like that, once you get up the tree a bit and you've got the money, these sort of things are quite lucrative, especially in terms of cash flow. So it really depends on what you're buying, but initially I'd say only 2 or 3 for most people is probably plenty in a trust, and then start to get more entities as you go along just to maximise how much you can borrow.
Are you cross-collateralising in that one trust structure to keep that borrowing capacity and serviceability? Is that how the banks look at them? That's
a good question. I'll say yes and no, because what will happen in that trust is that, for us anyway, we keep every loan separate. So they're not what you're calling cross-collateralised from a structure standpoint on that particular property. So if you've got 3 properties in a trust, each property won't be securing on the loan the other one. So they're all sitting independently for most people, but it's a business. And so that entity owns these 3 properties. So say something goes wrong with one of the properties, because it's owned by an entity, the whole entity is on the line. And that's why asset protection is something you need to have a think about, because if, let's say, I don't know, you had a massive flood and you're in a unit and they deem it was your fault, you left the bathtub on, or you caused the drama, and then all of a sudden the insurance is saying, oh no, it was your fault, you were negligent, we're not going to pay you. And all of a sudden you've got 3 properties in that trust, you've got no insurance to cover you, and you're up for a $2 million claim. Oh no. That means that lawyer from the other side they're going to love to sue you, because they've seen your entity, and that entity's got 3 assets in it. So they're going to go hard because they know they can claim against you because you've got all these assets in this entity. And so even though they might not have been cross-collateralized, all of a sudden the whole portfolio is on the line because they're owned by the one entity. And same with the bank, is that the bank might only have security over one of those properties individually. But if something goes wrong, because that entity is all exposed, there's no reason at all they couldn't start to go. If they don't get their money back from selling one property, then they can go to the next one in the entity because they're all guaranteeing the same thing.
Yeah, that goes from a risk perspective too, to not go, like when you say 2 or 3 sounds like a more healthy than putting like 4, 5, 6, because then you're more exposed.
Yeah, look, people get hung up about interest rates and fees. But in the whole scheme of building a portfolio, yes, they're important, but they're not the most important thing. If it's going to cost you $1,000 to set up another entity structure, that's minor compared to the asset protection benefits, the borrowing capacity benefits that you're going to have. If you can get one more property for $500,000, which doubles in 8 to 10 years, and now you've made $500,000 extra, that's way more than the $1,000 or $2,000 a year in fees to keep the thing going. So they're just got to have a bit bigger mindset. And understanding, it's about understanding as well.
With the I mean, that's set up like if you had 3 properties in that trust and then you sold one, would the banks want to get evaluation on the other 2 properties? Is that like...
That's a good question. Okay, so if you technically cross-collateralised, 100%. So if they were on the mortgage documents all securing each other, that's a massive downside of having cross-collateralised property. We still see it. I've talked about not doing that for 20 years, but we still see, obviously my word's not everywhere, but we still see people who've got cross-collateralised properties, and that's a nightmare, having that situation happen to you. So no. So if they're all in the one trust, no, you won't even if you sell one, they won't revalue the other 2. Because if we do it, they're not cross-collateralised from a mortgage standpoint. Yeah. If they were, 100%, they will. And we see it, and it's horrible, that if you sell a property and the bank does not like the coverage, because they will, if you've got 3 linked together, you sell one, they'll value the other 2. And if they haven't got enough security margin in there, they won't give you all the sale proceeds of the first one. And we've seen people get caught out like that, and even withheld the whole amount, and they bought another property. Imagine how stressful that would be. It's diabolical. Yeah, you never want to cross-collateralise.
Yeah, and by holding that amount, it's because the loan-to-value ratio is not to their appetite, so then they withhold it to their risk perspective as well.
Yeah, and sometimes they'll agree for you to purchase a property that they don't like the security, but because you're giving them another security, they've agreed to do the loan. But if you sell the good security and you've only got a block of land they don't like left, their lending margin might be at 50% on that land, and so you've got to make sure that the LVR is a lot lower on what's left. So it can get tricky.
So I guess that having a couple of properties in one structure being cross-collateralized has a lot of similarities in terms of people being fixated on interest rates, where people are very worried about the short term and not having the foresight to think about the long term, benefits or downfalls. Like with an interest rate, maybe they can't, if they're too fixated on something, they're worried about paying too much money up front, but they're not foreseeing like how much extra property could make them in the long term. And the same with like the cross collateralization, seeing that like I could buy more properties in the short term, but not noticing or realizing that what could happen if they wanted to sell one of those individually and not as a whole, or even as a whole, and then not reaping the full capital growth of that because they're cross collateralized.